Hello, everyone. My name is Jim Butler. I'm the chairman of the Global Hospitality Group of Jeffer, Mangels, Butler, and Mitchell. And I'm really delighted to welcome you here today to our program updating hotels in CMBS, what's next in round two. We did this program, or one basically focused on the subject matter last year. And everyone was waiting to see what would happen with the federal stimulus, what was going to happen with the election, and when the recovery would come, the vaccine. Well, a lot of that has at least come upon us. The election is over. We know who's sitting in the White House. We do see the stimulus packages. The vaccine is in process, not going as quickly as thought. But we're coming up on a situation where the pain is not gone from the hospitality industry. And so what we're going to do today is have 5 different segments looking at the state of the hotel industry today. Jack Westergom of Manhattan Hospitality is going to show us where we are and maybe where we're going. The state of the CMBS industry, Manus Clancy of Trepp, the guys who have all the numbers on CMBS, is going to give us some dimensions on that. Our highlight of the show is our CMBS special servicers, 3 of the most experienced special servicers in CMBS, who are going to talk about what they're seeing in the trenches, where they are, what they're doing, where this is going, where the opportunities are. Greg Porter of HREC is going to give us a presentation on rescue capital. Where does this fit in the situation? How can you use it? When do you use it? What is the role? What's good and bad? What are the terms? And finally, my partner, Bob Kaplan, who is one of the best known people in the bankruptcy workouts and receivership field in the country, is going to give us a few tips on what he is seeing in the area. So we've got a big program, a lot to do today. I'm going to hand it over to Jack Westergom. Jack, take it away.
Good morning. Good morning, everybody. How are you? There we go. Good morning, everybody. When Jim asked me to do this, talk about the state of the industry, I had to pause quite a bit and really think it through. Over the past year, things have certainly changed from where we were in the beginning of 2020, changed throughout the year and are changing again. I just got back last night from a 3-day trip to Orlando for work. Based on the thousands of families I saw in the Orlando airport, I almost came back and changed my slides to reflect what I saw. One would think that we're back in 2019 again. And that's sort of what I titled my presentation, Back to the Future, because everybody keeps talking about getting back to 2019, a year that was in fact not a great year for us. But we've survived 2020. We're 2020 strong. It certainly was one of the strangest years in history. Most of us would like to forget it. As my little slide here says, oh my God, or I thought of 3 other letters might have been more appropriate, didn't use them. But it's definitely a strange year. But hopefully we'll all come out of this better off than we were going into it. This slide, prepared by SDR and HBS, talks about where they anticipate us going in 2021. Certainly an improvement from where we were last year, with occupancy increasing to 53.5, average room rate increasing slightly to 109, and RevPAR still a dismal $58.45. And it really doesn't matter who you ask, on their forecast. They're pretty much the same. This one prepared by SDR and Tourism Economics, and I actually love their work. We're going to be a little bit less in occupancy at 52.2 this year. Average room rate almost the same, and a little bit less in RevPAR. A couple months ago, maybe 3 or 4 months ago, we were talking about stay alive till 2025. I think we're starting to see some life in the industry today with travel, and the numbers are getting better, although we've got a huge hole to climb out of. 2021, it's a new year, but tried to break it down as simply as I could. The formula for return to normal, COVID plus a vaccine distributed evenly to everybody, minus the fear, which is the main thing stopping travel right now, and that'll get us back to a return to normal. 2021, a year that started off lots of hope, lots of promise. As Jim alluded, we have a new president, Congress, one party and majority, which you would think would make things easier to get new bills and laws passed. We have new vaccines available with the promise of more on the way. We anticipate we'll get a new pandemic economic package passed soon. Not quite sure what it's going to look like, but it'll be better than nothing. We have a new round of PPP funds available to select businesses. There is new hope for an end to the pandemic. There is growing hope for return to normal business in the CRE and hospitality sector. Yet, the reality of it is we still have gridlock in Congress. We're short on vaccine, although more is promised. Vaccine distribution is slower than anticipated, with each state deciding how to distribute. I got my first dose of Moderna, as I think Jim did recently. We both felt like we won the lottery when we actually got it. And half the people I talked to on the plane going to Orlando and back yesterday were talking about vaccine and when they got it or when they were hoping to get it. Airlines continue to furlough workers. American Airlines just announced another anticipated furlough within the last 2 weeks. Required testing for all U.S. flights is now being considered, a move that I personally hope doesn't happen because it will cripple our industry even further. The horizon for the return to normal in 2019 seems to have stretched out to year's end. Is the virus in retreat? The drop seems to be real. New cases per day in the United States have dropped off considerably. Patients in the hospital with COVID-19 by day has dropped off considerably. New deaths in the United States per day, and sorry for all the grim facts I'm showing, has dropped off considerably as well. Is the vaccine cavalry really coming to the rescue, or is it just a mirage? Signs of hope. So I think it's not a mirage. Net bookings for January 2021 begins to show a bit of promise when compared to December 2020, according to Duetto. Group RFPs are up significantly for 2021, according to CVEN, that actually helps book meetings via RFP digital. According to Noland and a survey they just recently completed, many meeting planners count on group bookings for later in 2021. Weak brands are being replaced with stronger brands. Weak sponsors are being replaced with stronger ones. This is part of the CVEN survey they did, showing the following cities with weaker RFPs in 2021, but already looking at stronger RFPs for group bookings in 2022. New York City's at the top of the list. Stronger RFPs in both years, with Orlando, where it just returned again and has actually had a meeting in the hotel I was at. But a lot of the cities listed below showing stronger for both years. San Francisco, Washington, big meeting cities, Atlanta, same thing, weaker in both years. And then the following cities showing stronger in 2021, but weaker advanced bookings I think the one thing everybody can agree to is booking time has been reduced pretty much 30 days for any corporate group meetings that are out there, and the day-to-day bookings are actually very, very short-term right now. Pent-up demand does exist for leisure travel and group meetings. Alternative healthcare and government-related business has helped to fill hotel rooms. Essential travel has found a way to travel. Many luxury and ultra-luxury resort travelers have switched to private jet travel, as private jet travel has made it convenient, more easy, and more economical for people to use. Travelers trading down to select service and budget hotels, so those hotels outperform the rest of the industry. Robust occupancy recovery should set in during the summer and fall of 2021, concurrent with the majority rollout of the vaccines behind us. Corporate rated business room rates will take years to recover. And by the way, it took 4 or 5 years to recover in major cities during the last downturn. So not much different there. Overall, ADR recovery will lag occupancy recovery, with full RevPAR recovery expected by 2024, almost the same as it was during the last downturn. Transactional volume is up, anticipated to pick up when lending opens up more widely and recovery in NOI is documented and price declines diminish. Meeting business is expected to return with strength. Zoom fatigue has set in, hopefully and thankfully not for all you folks out here listening to us right now. And people are ready and excited to meet again in person. High and continually increasing construction costs will keep new supply in check through the near term. Numerous potential investors will create competition for deals, which is anticipated to fuel transaction activity and mitigate values. One of the thoughts on here is that there's still a gap between buyer and seller out in the market today. But I'm a person whose glass is always half full. Hope springs eternal, and I do see some green shoots out there. My final thought, great uncertainty means great opportunity for all of us in the hospitality industry. And thank you for allowing me to say a few words today. I'm going to turn it back over to Jim.
Thank you, Jack. Well, that's an interesting picture, and I think your trip to Orlando kind of describes the situation that most often averages are very helpful to understand trends because the data are grouped around the average, the median. But it seems that in this downturn, the results are so scattered, there's almost no trend. You've got Orlando, which doesn't know that there's a COVID-19 pandemic going on with everybody turning out, and you've got places still in severe lockdown. You've got hotels that are running better than they were in 2019, and you've got those that have no hope of cash flow for another 2 or 3 years. Thanks, Jack. That's a very helpful presentation. And the slides will be available after through our website. We'll make that available. Well, commercial real estate has really been facilitated for decades by the CMBS market. Hospitality is one of those segments, office, retail, multifamily. And to get our arms around that, let's ask Manus to tell us what's going on in CMBS, where we've been, where we're going, where we are.
Thanks, Jim. Thanks for having me. Grateful to JMBM for hosting this. I'll try to make my remarks fairly brief. I'm as eager as anybody else to hear what the special servicers among us have on their mind, because that's really where the rubber meets the road right now. For those that don't know Trepp, we are a data modeling and analytics firm in New York that collects data from banks, from the CMBS market, from the GSEs and so forth. So that's who we are. I've been in the business for about 25 years, a modeler by trade, although more recently it's much more research. And thank you for Doreen for pulling up these slides. If you could move to the first one, a very quick overview of what the CMBS market is. Currently outstanding, it's a $550 billion private label market. So that would not include GSE multifamily products. So no Fannie or Freddie. Since 2014, we've averaged about 90 billion in originations per year. Last year, we were certainly on that pace or better until COVID hit. And in a sign of real resiliency, we still came up with 60 billion last year, which shows kind of a really healthy comeback. Overall issuance over the last 20 years, about $2 trillion. The CMBS market serves all major property types: retail, office, multifamily, hotel, industrial, and self-storage. If we could move on to the next one, Doreen. Thank you. Why does the CMBS market exist versus, let's say, insurance companies or banks? In the CMBS market, borrowers are attracted to higher proceeds and the non-recourse feature of CMBS loans. People can throw back the keys with really no ramifications if they so choose. We're seeing that a lot right now with malls and hotels in some cases. Most financing is 5 or 10-year fixed rate debt. Average LTVs for CMBS are 5 to 10 points higher than for bank loans, depending on property type. The average CMBS loan is 50 to 100% bigger than the average bank loan, and loans in the CMBS market anywhere from $1 million to as big as $3 billion. If we can move on to the next one. The reporting requirements in the CMBS market for borrowers is really, really extensive. And for this reason, people look to this data much more so than bank data or insurance company data for color as to where the market is going. At origination, you will get historical and underwritten NOI, net cash flow, occupancy, appraised values, LTVs. You find out who the top tenants are, how much square footage they have when their leases expire, the rent per square foot. Over time, you get the loan's payment status, whether it's 30, 60, 90 in foreclosure, whether it's flipped to REO. You get a special servicer workout code and comments often as to what the special servicer is seeing from the borrower. On a quarterly basis, the borrower is required in most cases to update the net operating income, net cash flow, debt service coverage ratio, occupancy, top 5 tenants where applicable, and so forth. And you do get a rich amount of loan resolution data. So if a loan is paid off, it's defeased. If it was paid off with a penalty, or if it suffered a loss, you find out precisely how big that loss was. So great for modeling and great for looking at forthcoming trends. Moving on. A comparison to the great financial crisis versus today. During the great financial crisis, we went 21 months with no issuance whatsoever. There was no lending, there was no liquidity. In the COVID times, we saw no CMBS issuance for about 60 days. The markets opened very quickly. A lot of that can be attributed to the reopening of the TALF program, which stabilized the markets considerably. Lending spreads during the GFC, the great financial crisis, AAA spreads, 1,500 basis points over treasuries. So AAA bonds at times were trading for 50 cents on the dollar, if you can imagine. In this crisis, AAA spreads got as wide as 350 over the curve. And as of late 2020, we had retraced all of our widening. We were as tight at the end of 2020 as we were at the beginning of 2020. In terms of open markets, during the great financial crisis, there was really no lending of any sorts by the CMBS market. During COVID time, it has really been quite robust for multifamily, office, industrial, and special servicing. Some in retail, but not much, and virtually none in the lodging sector. Moving on, just a comparison between 2019 and 2020. You could see in the top 3 lines, either improvement in the case of industrial or only modest degradation in terms of delinquency rates for office and multifamily. You know, I would say there's a little bit of fraying, whereas for retail and lodging, what we saw was a real unraveling. Retail went from 4% in 19 to almost 13% year-end 2020. Lodging 1.5% year-end 19, almost 20% at the end of 2020. Moving on to the next one. Overall, we peaked in June with a delinquency rate of 10.3%. That was very close to the all-time peak that was set in 2012. We have since then seen 7 consecutive months of falling delinquency rates. Moving on to the next slide. Lodging, we peaked at a 24% delinquency rate in June 2020. That compares to a peak of 19% in September 2010. Moving to the next one. Retail, even more stark, 18% in June 2020. During the great financial crisis, 8%. Moving to the next slide. The overall special servicing rate, here we haven't done as bad. We've hit it about 10.5% during COVID. During the great financial crisis, we peaked at 13%. There's a little bit of inside baseball with that 13% number. A lot of that had to do with during the years 2011 and 2012, the good loans were squeezed out and you were left with only bad loans. The denominator really disappeared in many ways, and you were left with adverse selection. And as a result, in 2011 and 2012, you really saw high numbers of special servicing percentages. The next slide. Special servicing rates over time, 26% for COVID, 26% more or less during the great financial crisis. That's for lodging, I should say. Next slide. Retail, again, much worse now, 18% during the COVID period as a peak, 11% during the great financial crisis. Next slide, please. Property type review in the retail space. There is some nuance to the market. Where there's real concern is in the shopping mall space, which is just getting obliterated in terms of valuations, jingle mail, delinquencies, defaults, and so forth. That is a function of retailer bankruptcies, lease rejections, store closings, and as I mentioned, valuations and jingle mail. There are a few pockets of resilience, grocery anchored outdoor shopping centers, and anything anchored by Target, Walmart, Home Depot, Costco. Moving to the next slide. Lodging, everything's been really hit hard. To Jack's point, New York, Chicago, Houston, and Portland really troubled. Most hotels saw partial year 2020 debt service coverage ratio well below 1.0x. There's no financing right now, and there's falling valuations. Areas of resilience, there is plentiful distressed capital waiting on the sidelines, pent-up demand for leisure travel, and in the special servicer accommodations, we saw a lot of use of FF&E reserves to allow borrowers to keep their loans current. Moving on to the next slide. Very quickly, in office, this is where there's a really debate. There's an enormous amount of sublet space in some markets, a fraying of the co-working market, which is a big taker of space over the last 2 or 3 years, and questions about renewal demand. In the multifamily side, we're seeing rapidly falling occupancy in major cities. We're not really sure what the long-term impact of the eviction moratorium will be, and we do worry about long-term demand in 24-hour cities. Moving on to the next slide, I'll leave you with one last thought. Jim and I talked about things like who is the controlling class, who makes these decisions about how to dispose of collateral, how does this come about? And for those that want to see a story with really negative ramifications, from servicers to CMBS investors to CMBX longs and the whole litany of people there, you can look to the Prism Outlet Mall story. It used to be the fashion outlets of Las Vegas. It was valued at $125 million in 2012. It was still valued at $28 million in 2020 by a third-party evaluator. The asset itself was REO. It had an unpaid balance of $62 million. The collateral was about 400,000 square feet of mall space. The top auction bid was 1.5 million, which met the reserve. So really only about 1% of its value in 2012. And what made this so scary was this loan has $20 million in unpaid advances at this point. So you're looking at a loss that will be, assuming this deal closes and 1.5 million is the final price, of more than 100%, which means that servicers have to wait for their money to get replenished for their servicer advances. Investors who are using that $28.2 million number to figure out what credit protection was for their investments have to re-underwrite and say, wow, I had a lot less credit enhancement than I thought. And we expect this to happen in spades over the next 2 or 3 years. And with that, thank you again, Jim. I hope you learned something today. Jim, you're free to share the slides, and I look forward to hearing from our special servicing guests.
Thank you, Mass. You know, I really enjoy the Trepp daily newsletter and all the materials you send out. If anyone isn't aware of this, you should go to the Trepp website and see the incredible resources that are available on CMBS. If I recall correctly, something like, it seems almost low, but 25% as the number that sticks in my mind of the lodging in the United States has CMBS financing. And according to the slides, 20% of those were basically in a delinquent status. So we've got it's a very significant impact here.
I'll leave you with one more scary thought. Between what's with special servicing and with watch list on the hotel space, 70% of all hotel loans in CMBS are in one category or the other at this point. So it's really where it's ground zero, I hate to say it, for distress.
I know in many ways you are a recorder of data, not necessarily a prognosticator, but do you have any sense of where this is going? Does it get worse before it gets better, or are we out of the woods?
I think that the recovery will be bifurcated. To Jack's point earlier, I think we see a huge recovery in leisure travel as soon as people get comfortable. I think that is explosive. Somebody said that it'll be New Year's Eve every night over the summer if we can get herd immunity. I worry more about business travel. I think that CFOs have become quite addicted and dependent on the savings that they've had from business travel. And it takes two to tango, right? If you want to get on a plane from if you're a guy from Salesforce, there has to be somebody at the other end of that visit to meet you. And if your visitor is going to work 2 days a week, you don't have that demand for the business travel. So I do think it's very bifurcated.
Yeah, that's a very good observation. And I think that's part of what underlays what I call the scattering of results as opposed to following the trend line. All the data is not within one standard deviation. It's within 10 standard deviations, which means if you're in group business, if you're in urban, it may be 24 or 25 before the travel gets back. If you're in coastal drive to, you're probably doing better today than you were in 2019. Well, thank you very much. As I mentioned earlier, both the slide presentation from Jack and from Manus will be made available after our program, and the program itself is being recorded. So we'll give you a link for that. And that brings us to the main event of this program, talking with the special servicers. I'd like to ask them to first introduce themselves, and then our registrants submitted over 200 questions, virtually all of which were directed to the special servicers, and we grouped those into essentially five questions. So I'm going to ask Lindsay Wright of Greystone to lead off, just introducing herself and what Greystone does, followed by Andrew Hundertmark and then Kurt Spa, and then we'll get into the questions. Lindsay's in the middle of the storm of the century and in a whiteout, so she's hopefully still with us by telephone and can join in. Lindsay?
Yes, Jim, I am. Thank you. And I apologize for not being able to join everybody via video, but yes, it is quite a disaster here. Making the most of it though. So again, thank you for asking me to join again for round two. As previously mentioned on the first call, but for those that maybe didn't join, Lindsay Wright, am a senior managing director at Greystone, and we are an originator, an investor, a servicer of all commercial real estate. We primarily originate and service agency, multifamily healthcare properties, but we are also a large named special servicer, specifically in the CMBS and CLO space. Currently named the special servicer on over almost 19 billion worth of product. And we currently have active in our special servicing portfolio right around 4 billion in loan and REO, distressed, defaulted assets. And the largest of those are retail at this point. However, we have seen a lot of hospitality come in the shop, as well as some multifamily too. But primarily it's focused on retail. And when we had this seminar the first time around, we were just coming out of the months of March, April, May, when all of us as special servicers really got hit hard with a wave of new transfers, forbearance requests, asked from specifically our hotel borrowers for some sort of forbearance or relief because of COVID. We worked through that. We all were able, I think, to take a little bit of a breath over the last few months, kind of reassess where we are, look at the forbearances and modifications that we did. And I think going into 2021, my perception is, we're going to have to look at some of those again. And we're also going to have some new things coming our way, specifically, again, on the retail front. But then I also think the office, there's some lag and some pent up distress there that's coming. And multifamily is also kind of a wild card. A lot of that is going to depend on some of, in certain markets, some of the eviction moratoriums, just getting back to work, and what the GSEs and the agencies and the government do with a lot of these policies. So I think 2021 will be busy still. A lot that Jack and Mana said, I totally agree with. I think on the hotel side, it's, as we all know, the first to rebound back. And I do agree that we'll see an explosive, I like that word, Manis, an explosive rebound in the leisure front. But I think there's a lot of other markets that are going to suffer, and it's going to take years. And my concern, just overall, not just with hotel, but everything that we've seen in the past year and that we're going to see this year, the valuations of those assets, how much of a decline we're going to see from what they were originated at. So maybe we don't have a problem today, but when these borrowers get ready to sell or refinance or pay off at maturity, if that's a 5, 7, 10-year term, we might be looking at a real problem, because some of these values are so degraded, they're never going to come back.
Thank you, Lindsay. Andy, how about you?
Hi, Andy Huntermark, CEO of Argentic Services. We're one of the newer special servicers on the scene. We opened our doors last May and took over about 150 COVID-related forbearance requests from the prior special servicer that needed immediate attention. And ended up providing forbearances on probably a third or so of those. Had about a third that backed out, and about a third that decided that they could hang on. We are named on about 20 CMBS deals, 3 CLOs, about 12 to 13 billion in in notational value. Got about $1.2 billion or so in special right now. We've been working hard over, the past close to a year now, doing a lot of modifications, a lot of forbearances, couple of foreclosures, surprisingly few really. And those were really cases where the borrower said, take the keys, I'm done. We have had quite a few borrowers come into special and then decide they didn't like it and found the money to bring their loan current, a surprising number. And some of it has been very transparent in terms of, maybe pref equity, something like that. Other times, the money just magically appears when you file foreclosure or file for a receiver. Suddenly, they open up the mattress and find the cash. So it's been a wild ride, obviously, for our first 8 months in business. And I'll echo most everything Lindsay said. I think that 2021 is going to continue to be an active year. Hospitality will begin to fade as our number one problem, and retail will again rear its head. And I think that office is a very interesting place to watch. I mean, will the flight to the suburbs actually materialize once COVID is a back burner issue, and what impact will that have on downtown CBD office rents and occupancy and viability?
Thank you, Andy. And Kurt Spa, tell us what's going on in your shop.
I'm Kurt Spa. I'm with Situs AMC Special Servicing. We were formerly known as Helios AMC during the Great Recession. Had a pretty good book there. Got down to a pretty small staff, and now we've ramped up again, and it has been an interesting 2020 and 2021 now. Our book is a little bit different. We have some of the typical conduit product, but we have quite a bit of SASB product, which is single asset, single borrower deals. And so those obviously are larger by the description. We also have some commercial single family rental, and we're a CLO special servicer. We had a lot of deals come into our shop early in 2020, and it's like everybody else, we put a lot of forbearances in place, especially on our SASB product. Most of those are hospitality SASBs or leisure. And most of those just needed small forbearances. We have had a couple follow-up, what I would call minor tweaked forbearances, and they seem to be doing well. The urban hospitality, those are giving us problems. The retail is going to continue to give us problems. And like Andy said, looking ahead at 2021, 2022, we're very concerned about office and maturities. Getting back to what Lindsay said on valuations. Thanks,
Kurt. Well, that gives us some sense of what's going on, and let's dive into the questions. Andy, I'd like to ask you. You could probably spend literally an all-day seminar on answering the question, but I hate the scope.
Yeah, I'm wondering how we're going to get through all these in 22 minutes, but
exactly. Many of our registrants ask what's the difference between CMBS lenders and traditional lenders, or their questions show that they really don't understand why they can't, come up and sit down with you and cut a deal on something, or buy your assets, or whatever. So without going in to all the structures and agreements and trusts and so forth, can you tell us the basic difference between CMBS lenders and other traditional lenders where the rubber hits the road?
Yeah. I won't talk too much about the structures of the loans themselves. I'll focus on the back end where there's a problem, or even where there's an issue midstream where you're a performing borrower. So banks generally have more flexibility, I'll say. I mean, obviously they have regulators, and they need to watch their overall book. but they focus typically on relationships, or their large depository relationships in play or family relationships. And so they're not always strictly lending based on a certain LTV or a certain product type. They tend to be, they tend to move faster, I guess, in the size loan that most of CMBS is, the 10 to $12 million deals. Don't have to go through a lengthy committee process to have things worked out. They can put loans on non-accrual. They can write them down. It's just a little easier process. In our world, we have a pooling and servicing agreement that governs the individual trusts, and then you have obviously the loan documents for the individual loans. We're more, I guess, objective. I guess we don't have that worry of personal relationships, business relationships, etc. We don't have, you have personal guarantees for carve outs, but you don't have them the way banks do, where they can, come take your house if things really really go south. I think our process is just, and much of it is mandated by, again, these governing documents. The special servicer has to write up and approve a deal, and then the directing certificate holder has to sign off on that deal as well. In many cases, with larger loans, they're split across several securitizations and maybe under different special servicers, different master servicers, and that slows the process as well. So it can be extremely frustrating for borrowers, and I get it. In terms of getting to our assets, if you will, most of the pooling and servicing agreements require that we broadly market any loan or REO that we decide to sell. So one-off purchases are just not something you see much of in CMBS land, unless it's a par or very close to par execution that clearly results in a better NPV than going to market. So in general, I'd say those are the differences. Banks, you can sit down and cut a deal on an individual asset if you're an outsider or you're a borrower. There's nothing to preclude borrowers from sitting down with us other than COVID, but virtually sitting down with us and talking through various solutions. And we're certainly open to that. And I think that's still our first line of offense, if you will, is trying to get a modification done.
Thanks, Andy. I'd like, in response to the next question, rather than asking how bad is it right now, I'd like you to kind of wrap in to any responses you give at this point, some sense of what your flow is or what your perception is. It any different than Trepp? Do you see another surge? Is this mostly the old forbearances wearing off? And the question is, what's happening in response to round 2 of the initial forbearance? Who'd like to lead off? Lindsay, do you want to take that?
Sure. I'll be quick, because honestly, we did not ink that many forbearances or modifications from that first round in the grand scheme of things. And the reason being a couple of the buckets that Andy referenced. Some of them some bars just decided they didn't want to be in special servicer and fix their own problem. The second bucket was the ones that were a pretty quote unquote easy, forbearance or modification. And we got those done pretty quickly, got returned back to the master servicer. The third bucket is the more complicated ones. And those are the ones that I'm still dealing and grappling with right now. And they might have come in last year because of COVID. And we just don't have a resolution yet for many different reasons. But one of those reasons is this uncertainty. And that's what is plaguing all of us, as was plaguing the industry. It's what Manus was referring to too. Until we know how this is going to end, and if we get the the herd immunity this summer and everybody, goes back out and lives their life and offices start opening back up and all of that, okay, great. But I don't think any of us know that yet. And these borrowers don't have a real concrete plan either, specifically on the hotel front, specifically on some of our office properties where tenants have a lease rolling and maybe they don't need that much space anymore, or maybe they don't want to sign that new lease for this new space. They're going to stay where they are and downsize. I have several examples of that right now live in my shop where I've got, an asset, a hotel asset that is near an amusement park. That borrower is not willing to, do a new deal or fix the issue right now. We're just waiting to see when, California and Disneyland opens back up. I've got another hotel in California that's tied directly to a convention center. And until, business travel opens back up, he's not going to write that check that we need to get the modification done. I've got an office property up in the Northeast where the tenant is saying, because the borrower is one of these, we want to hand over the keys because we can't get a deal done because this tenant that's coming in wants a big TILC package and the borrower's not willing to write the check. Is the CMBS trust going to step in order to try to, snag this tenant and keep the deal alive? And then I have several retail properties where tenants are just not making decisions right now. Their leasing, committees are just not willing to pull the trigger on a lot of these deals yet until more is known. So I just think uncertainty is a key word in all of our business right now, from the lending side to the workout side to the valuation side, et cetera. So that's what we're grappling with, and that's where I see the biggest crunch in the next few months.
No, I think that is an excellent summary of the uncertainty factor that just hovers over and delays and often paralyzes both borrowers and the ability of lenders to deal with some of these situations. Many of the questions that were posed kind of view this, I suppose, either as opportunistic investors who wonder, why are you just kicking the can and why don't you move in and foreclose, and is this really extend and pretend? I know it's very different when you're on the other side, but Kurt, could you maybe take that on a little bit?
Yeah, I can. The forbearances are done not in a kick the can way or extend and pretend. This is different than the last cycle in my mind, in that, while there is uncertainty in the short term, I think in the long term, everybody sees things coming around. The whole cause of this downturn is different than the last time. So, we're more of we're on round two here of looking at these things after initial forbearances wear off. I'm looking at it more as a light kick of the can, maybe, if anything, but really not even that. We are going into these deals and looking at do we have a long-term problem, or is this really a short-term product? In our mind, leisure travel, based on what we saw last summer, based on what Manis said earlier, this pent-up demand, we're feeling the same way on leisure, hospitality. We're likely to make a small tweak to a forbearance deal or to a loan to keep those in place. Retail, on the other hand, that was having issues pre-COVID. That's a can, in most cases, we don't want to kick. And on retail, pre-COVID issues, it's been going down. I'll just mention, just to compare last cycle to this cycle, the Prism Outlet Mall that Manis mentioned earlier, we had that in the Helios AMC special servicing shop due to struggles. The struggles weren't nearly as bad. We got out close to whole on that. It got recycled. I guess you could say we're a green industry into another CMBS deal, and now you're seeing a complete hit. So retail for us, looking at that experience and others, is something we don't want to kick the can. We're probably going to pursue remedies. Again, on a CMBS deal, our servicing agreement tells us we're to net present value the alternative. So we're going to say, here's my NPV of a foreclosure, here's my NPV of a workout. first loss is best loss. We're using a discount rate on a lot of those deals. So it's as we've mentioned earlier, it's bifurcated. I see some mild kicks of the can again, but on maybe office product, maturing loans, retail, I see those getting resolved in opportunities in those sectors.
Thank you, Kurt. Boy, we could spend a lot more time on this, but we need to move on. What's your advice? What should a borrower do in working with a CMBS lender? We have questions of, do we have to default to get attention? There's apparently some frustration or unhappiness with the inability to get callbacks from borrowers. And what is the best way for a borrower to approach a CMBS lender?
So there, unfortunately, I think the biggest bottleneck is at the master servicer level. Since there are none of them on this call, I can say that. Although I'm sure there's some listening, and I don't want to upset anybody. But I mean that from the standpoint that I don't know that the average borrower realizes that if they're having a problem, their first reach out needs to be to the master servicer, to the entity they're getting their bill from every month, or to the entity that's debiting their account every month, however it may work. They're really the gatekeeper, and they, again, pursuant to the pooling and servicing agreement, make a determination as to whether a situation can be handled with a non-transfer and it's a borrower consent type issue, a lease approval, or a property management change, something like that, or whether the problem is deeper, and if the borrower really wants to explore a modification or a forbearance, they need to be persistent in their reach out to the master servicer, and ultimately the master will reach back down to the special and say, hey, there's the issue. Do you want to take this in as an NT and see what happens, or do you want to take it in as a transfer and see what happens?
And
at that point,
I know there are some people who say, don't waste time with the master servicer. You really need to move straight to special, and until you say I'm going to default on my loan or you miss a payment, you're not going to get any attention. What would you say to those people? And maybe you can tell us a little bit about the costs involved going into special servicing and what that means, why this isn't necessarily the key to the Magic Kingdom.
Yeah, no, it's not. So typically, a loan will not automatically come into special until it's hit 60-day delinquency. So, but that's not necessarily something you want to do as a borrower unless your cash flow and your situation causes it. It's not something you want to intentionally do. If you know, either by digging through Trepp or other publications, if you can figure out who your special servicer is, or who the name special on your particular loan is. We get reach outs from borrowers all the time, and my suggestion to them is you need to go to the master servicer, you need to state your case, CC me on the email to the special servicer, and we'll work to get you transferred in here if that's the appropriate relief, if you want to call it relief. Now, when you come into special, there is a cost. There are certain obligations we have with regard to a defaulted loan or an imminently defaulted loan. We have to get an appraisal. We will likely get a title update. We will engage counsel. We will send out a pre-negotiation letter. There are special servicing fees of 25 bips annually based on the UPB of the loan that are prorated, obviously, for the time it's in special. There's default interest, that late fees, which accrue whether it's in special or not if you're missing payments. But and then there's typically going to be a modification fee or a consent fee or whatever it may be. So it's not a I won't say it's not necessarily a pleasant experience. You're in default, it's not going to be pleasant, but
those fees could be pretty substantial. I mean, the default interest is often
Yes.
double the base rate plus the default payments as
Yeah.
an additional charge.
Now, I will say in the current environment, particularly with hospitality assets, we've been I think, very generous in terms of conditionally waiving those default interest and late fees, assuming that the modification performs to full term and the loan returns to its performing status. Then we will typically waive those in hotel deals because of the special circumstances of COVID. But it is an expensive undertaking. You need to think hard about it, and you really need to try and get a dialogue going with your master servicer. And I know that's difficult and easier said than done, but as a secondary way in, if you will, dig into Trepp, figure out who your special is, and try and make a connection there.
Thank you. As the last question for this panel, there's so much great stuff here. Many of our people of the people on the program would like to do business with the special servicers. Their dream is to buy assets at the 40 or 50% discount at your back door, cut a deal for a portfolio. You've indicated that's kind of hard with your fiduciary duties, that you have to go to a broker and test the market. And even though you have a good friend who can introduce you and vouch for someone, that probably isn't going to work. What are the opportunities that are going to come out of the special servicing? Who are the brokers or others they should go to? What are the opportunities to be receivers or be managers for you? What do you guys need? And I'll kind of take this in the same order we opened. Lindsay, why don't you lead off for us? How does somebody do business with a special server? Is there any opportunity? Are there ways? Are there?
Sure. Well, I mean, we have at Greystone, at least, we have to have, you as an approved vendor in order to, get you to bid for third-party reports, for receiverships. There's certain jurisdictions where we don't have a choice on receivers, but we do most of the time have a say, property managers, et cetera. I would say on the resolution front, though, buying assets, buying loans, buying REO, at this point in time, we haven't been a large note seller of the latest round of distressed assets. And that's just because we just didn't think it was the right time. When we do, there's different platforms. We'll take that for a note, for a defaulted note. We like the auction platforms, the 10X, Real Insight, et cetera. And that's just a good way to test the market and get a lot of eyes on an asset in a very controlled and efficient way. When we have, REO properties, most of the time we do like to run a full process on that, and we're in most circumstances engaging the large national brokers, the JLLs, the CBs, the Cushmans, Colliers, et cetera. So as long as you're, reaching out to those national brokers and those auction houses, and you have your name on a list, you're going to be contacted. You're going to be made aware of when we have, assets going to market. I would just say at this point in time, there's not been a lot of volume coming out of our shop, nor do I expect anything significant in the next 30 to 60 days. We still have, some things to work through, as I alluded to earlier.
That was a pretty good answer. Andy or Kurt, do you have anything to add?
No, I would echo those comments. We're gathering some assets for a potential early second quarter sale, but we've still got a lot of ongoing negotiations, and still have foreclosure moratoriums in place in many jurisdictions that have really hindered our ability. You've got closed courthouses, which make it difficult to get a receiver, which, some things you want to do before you bring it to market because it'll help pricing. So I think everything's still kind of in neutral in that regard.
Kurt?
Yeah, I agree. We're in the same boat. We haven't foreclosed on too much at all. And I think we will probably spend a little bit of time with what we have to position it when we do foreclose, but there's really not much there. We do have the fiduciary responsibility. We will be using the 10Xs of the world and no sales advisors, brokers, et cetera.
Great. Well, I guess this is the perfect lead in for Greg Porter and his Rescue Capital platform. As you've seen, you aren't going to be able to take your billions of dollars of capital and go make a joint venture with the special servicers. They just can't do that. You're going to have to either find the borrower or someone else to use your capital with. And borrowers should be thinking about this and reaching out before it's too late. Greg, tell us a little bit about yourself and about your Rescue Capital platform.
Sure, Jim. Jim, thank you for hosting this event, first of all, and for inviting me to be a part. It's a pleasure to be here. And if I had more time, I would thank you and JMBM for hosting the Meet the Money Hotel Conference over the many years, and for the excellent wine and heavy appetizers you always provide at the event reception, at the evening reception. But we've got a lot to cover, so let's get into it. I'm Greg Porter. I'm a senior member of HREC Investment Advisors, Capital Markets, and Mortgage Brokerage team, and I'm here to discuss Hotel Runway Capital, what it is and why it makes sense to use it, or when and why it makes sense to use it, and how to find it for your hotel. Runway Capital is available today for hotels that were properly leveraged and positioned prior to COVID. And it's also a hotel owner's opportunity to find a strategic capital partner to help you grow as we emerge from the downturn. So first, let me tell you a little about our firm. HREC is the country's largest brokerage and advisory group dedicated exclusively to hospitality sales and finance. We're 44 hotel sales and mortgage brokers and advisors in 19 offices across the country. Personally, I'm a 30-year finance pro. I previously served 14 years as a CMBS loan originator for Bear Stearns, Merrill Lynch, and 5 Mile Capital Partners. And I've worked exclusively in the hotel finance space with HREC over the last 4 years. So last spring was a shock to our system, to put it mildly. At HREC, we put our heads together to see how we could apply our expertise in industry relationships to help our clients protect their equity through the pandemic. We wrote a white paper on Hotel Runway Capital. We interviewed over 50 active hotel equity sources, including family offices, private equity shops, and hotel ownership groups with capital ready to deploy. And we're actively placing Runway Capital for clients in addition to our core business of arranging first mortgage loans. So let's talk about what Runway Capital is. It is a third-party investment, typically in the form of preferred equity, used to stabilize your hotel's financial situation and defend your equity. The capital is commonly deployed in conjunction with a loan modification and, in some instances, a loan extension with the current lender. Funds go to pay off accrued interest and lender fees, used to retire accounts payable at the hotel level, and funds are set aside to cover anticipated debt service and working capital shortfalls in the coming months. In some cases, you have CapEx and PIP requirements, and pref equity can come in and fund those as well. How much do you need? You should do the math, but let me give you a couple of examples on deals that we have in-house. We have a 2-pack of Comfort Suites where we're raising between $1 million and $1.5 million per property. We have a DoubleTree where we're raising a little over $2 million. We have a 660 key full service convention hotel where we are arranging a $10 million pref equity injection. And we have a 27 hotel portfolio where we're arranging an entity level facility that should run between 30 and 40 million. So let's talk about pref equity terms. Pref equity, it fits between the debt and the common equity stack. So it's paid after the first mortgage and before the common equity. It's quasi debt in that it has a fixed term, typically matched with the loan, that is typically matched with the loan term, and it has an interest rate coupon, but it's equity in that there's no lien on the property. Pref equity typically comes in one of two flavors. Flavor number one, the pref interest can accrue, it's called PIK interest. And flavor number two is current pay, where you see the preferred interest reserve, say 1 to 2 years worth built into the use of funds. So let's talk about what it costs. Pref equity investors are typically looking for a mid to high teens IRR on their investment. So I'll give you an example bid. You could see a 12% coupon where all cash flow after debt service goes to pay that pref, and then additional cash flow could waterfall, say, at 50-50 between the pref investor and the common equity until the pref investor achieves, say, an 18% return. So, and another way that you could see it, a 12% coupon through the life of investment, and then the pref equity gets an equity kicker of, say, 20% at a sale or refinance. So, you know, this isn't cheap money, but, you know, it's better than tossing the keys and getting no return if you feel that you have equity that you want to defend. You know, and beyond that, you're aligning yourself with a strategic partner who's not only bridging you through the pandemic, but he's also your partner for opportunistic plays as you grow your portfolio in, you know, future months and years, and take advantage of situations that you see in the market. So look, if you can call, you know, capital call your investors again, or you can borrow friends and family money at 10%, you know, go ahead, do it. This is not that. What it is a strategic relationship with an experienced hotel capital source that's providing you money to get in place, not just for the next 3 months, but all the way through the pandemic, so that you can get yourself out of special servicing and really sleep a lot better at night as we emerge through the pandemic. So, yep, Jim, did you, or just checking in?
Thank you, Greg.
Yep.
That's very helpful. And the key here is ask early and do your homework first. Yeah,
that's right. I mean, I do have a few tips. If you're in the market for hotel runway capital, you want to determine whether you qualify for a previous stabilized hotel. If your debt yield in 2019 was under an 11%, an investor is going to conclude that you were over-levered going in, and you know they're not going to throw good money after bad. So this really works best for properly levered projects. You want to put together a 2021 pro forma. Well, you probably have it, but you want to review it to determine how much capital you're going to need, and then put together a 5-year pro forma, or better yet, a pro forma that takes you to loan term. And then you want to ramp that NOI. My advice is to ramp your NOI, take your 2020 pro forma, that you had projected before the pandemic and ramp up your cash flow to get it back to that stabilization in 2023 or probably 2024 if you're a full service hotel. You want to demonstrate that you could take the pref out. And another piece of advice that I want to share is prepare your asset management and property management reports to tell the story on what steps you've taken to adjust and remain competitive over the last year. So Jim, kind of to wrap it up, if you've decided to defend your equity, align with a capital partner now. Hotel owners keep coming to the servicers, with their fists up, only to discover they're in a knife fight. And sooner or later, it's going to be a gunfight and you want to be armed. So when you're working with the loan servicer, you need to give to get. The servicers want you to bring fresh capital in. You heard it from the panel. They don't want to foreclose. So get current, get out of the lockbox, arm yourself with capital to get you through the coming year. Take this opportunity to align with a strategic capital partner. They're out there waiting for you. And that's my advice.
Thank you very much. Before we get to our final speaker, Jack, I just want to get your thoughts on the importance of that budget and forecasting, and how do you get a bullshit barometer on these forecasts so that numbers are meaningful and can take you where they ought to go?
Thanks, Jim. Budgeting, suffice to say, is very important. Special servicers are very, very smart people. You come in with a budget that for 2021 that says, oh, by the way, we're going to run 80% occupancy from June on. Chances are they're probably not going to buy that. Normally preparing a budget, there's probably 20 or 30 things you look at. The biggest ones are historical data. Right now really doesn't have a lot of bearing on preparing a budget. The other one's future bookings, which, as I stated earlier in my piece, certainly on the group side, group bookings are very short term. They're not 90 days or 120 days, 6 months. They're right now happening 30 days, 40 days out. The good thing about this pandemic is we've been running leaner hotels. The hotels have learned to do without a lot of mid-management staff, a lot of trainees, interns, and other things that add expense. I'm thinking that when you do your forecasting, don't jump back to the budgeting that you would have had before in a normal situation from a staffing perspective. We've got to come out of this leaner and meaner and smarter than we were before. Otherwise, we're going to be back into it again the next time around. So there's best practices coming out of this. And the second thing is there is unique and different markets available out there now that didn't exist prior to pandemic, that have been caused by the pandemic. Some of those are going to stay on, but you got to think out of the box. What could I do different than I did before? And make sure your numbers are realistic and numbers that you can stick by. The last thing you want to do is submit a budget and be a hero with the budget and be a fool 6 months later when you couldn't come anywhere near meeting those budget numbers.
Thanks, Jack. Bob Kaplan, I guess if nothing else, the last year has certainly reinvigorated the bankruptcies, receiverships, and workouts. Give us a few of your highlights of what you've seen or advice you have.
All right, thank you, Jim. Yeah, I'm just going to touch on some practical issues we've seen in hotel receiverships. The first issue that comes up in a lot of them involving resort or high-end hotels is liquor license issues. Typically, for whatever reason, liquor licenses at most of the hotels we've dealt with in either receiverships or forbearance agreements are not owned by the borrower. So that creates an immediate problem because the note holder does not have a security interest in the liquor license. But as a practical matter, if you're running a hotel, the bar, restaurant, whatever, pools, cabanas, you want to be able to still serve liquor and beer to keep your revenues up. So what we've done basically through receivers, of course, is to generate something called an interim beverage management agreement, where the receiver enters into an agreement with the actual holder of the license to basically continue operations of the hotel or resort through the existing liquor license, and to get signed whatever documents required under, and many times you're dealing with state law, local law issues related to liquor licenses. So in exchange for this, the receiver basically is appointed to essentially direct the management and supervision of beverage service. So it's sort of a workaround around the fact that you do not have a lien in the liquor license, and the receiver will agree to comply with any local laws involving this. And the receiver typically will engage employees to serve liquor, of course, over the legal age. And in exchange for this, of course, the receiver has to pay some money to the holder of the liquor license and administer the operation, deal with expenses, which basically may mean PPP, personal property advances, or so forth. A caveat on all this is, one, if you have a litigated receivership, you're probably not going to be able to do this because it really involves a cooperative borrower and liquor license holder, typically who are affiliated with the borrower. And many times, if you have a litigious receivership, if I were representing the borrower, which of course I never do, I might not want to do this because it puts pressure on the note holder to somehow deal with other aspects of what's going on. Because if you can't serve beer or alcohol, you obviously are going to have a revenue problem. And I'll emphasize that this is really a very local law issue. So you really have to get counsel involved who knows something about liquor licenses, both at the state and city or county level. So that's one practical thing we've been seeing. Fortunately, most of the receiverships we've been involved in have wound up being consensual. So we've been able to do this. The second thing we've been experiencing in most of our receiverships are dealing with the comfort letters or the subordination non-disturbance agreements, which I'll call SNDAs, that have been signed with respect to either management agreements or franchise agreements. You really need to be very careful before you start any receivership or foreclosure proceedings when you have either a comfort letter or an SNDA. Typically, most of them have been negotiated years, of course, before there was a loan default. And you need to make sure you comply with all the provisions that the original lender agreed to. Typically, in some of these, we've seen the simpler ones are you just have to give a certain number of days notice to the manager or the franchisor before you start a foreclosure proceeding or appoint a receiver. That's not too bad as long as you give the notice. The more draconian ones require that the franchisor or manager actually be provided with a copy of the proposed order appointing receiver to make sure that the order complies with the pre-existing management agreement or franchise agreement. And so what this sets up, of course, is if the order does not comply, if you file a lawsuit to appoint the receiver or start foreclosure, you may have the franchisor or manager trying to what we call intervene in the lawsuit, saying the note holder as a successor to the original lender is not complying with the management agreement or franchise agreement. So not only do you may have a fight with the borrower, you may have to fight with the franchisor or the manager. Some of the more onerous SNDAs we've seen also state that the note holder cannot take any action to direct the receiver not to assume the existing management agreement. So that's very problematic. And Jim, I know you've discussed before, what is the value of selling a hotel ultimately if the existing management agreement or franchise agreement remains in place or is rejected? Now, so you have to walk a very delicate line here, because if in your heart of hearts you believe that the franchise agreement or management agreement should be rejected, but the SNDA or comfort letter says you can't encourage the receiver to do that, you need to be very circumspect in how you communicate perhaps your intentions to the receiver, who of course is an officer and agent of the court who needs to make an independent decision about this. We've gotten involved once before in a case where I think the franchisor basically tried to sue the note holder, saying you breached the provisions of the comfort letter or SNDA because you encouraged the receiver to do something that was prohibited. The good overriding news on all of this, of course, is the receiver is not a party to any of these documents. And under most states' law we've operated, the receiver has a fiduciary duty to maximize the value of the receivership estate, and also, more importantly, is usually given a reasonable period of time to assume or reject executory contracts. And a franchise agreement or a management agreement is a classic executory contract. So even though you as the note holder may not be able to encourage this or even make any comments about it, The receiver normally can make an independent evaluation of this and then go to court and hopefully get an order from the judge saying, I think the receivership estate has greater value if we reject this management agreement or franchise agreement, and therefore, please, judge, authorize the rejection. And that obviously is a decision that has to be made carefully. If you manage to reject a franchise agreement or management agreement, you may have to deflag the hotel. You don't have a reservation system. So all of this needs to be planned out. But the bottom line is there's a great power in most receiverships to get rid of onerous pre-receivership contracts of any type. It doesn't have to be a franchise agreement or a management agreement. And so we've seen receivers using that power many times to maximize the value of the assets.
Thanks, Bob. And that value can be tremendous. It can literally double the value of an asset. We've seen an asset that was valued 40 million encumbered with management and 80 or 100 unencumbered. Those kinds of ranges are certainly possible. So that brings us to the close of our program today. We want to thank all of you for joining us, and want to thank every one of our speakers for the wisdom they've shared with us today. We will make everything here available, the recording and the slides. Thank you.